of this along with copies of the slides afterwards. So, so who am I? And I already know a lot of you all on here on a personal level, but for those of you who I don't know, my name is Logan Burchett. I'm the co-founder and COO of Forecastr. And before I go any further, I'll say if I don't know you personally, then I would really like to. As a part of my follow-up, I'll send a link to my calendar, and hopefully I'll be able to meet everybody that was able to show up here today. But I've been in finance for pretty much my entire career, starting in the financial planning department of a middle market company in Cincinnati, and eventually hoping to manage a $16 billion stock portfolio for the Kentucky Pension Fund. But my most recent gig, though, prior to Forecastr, was being an outsourced CFO for pre-seed to Series A startups. And in that capacity, I built hundreds of models, helped raise millions of dollars in capital, and I've pretty much seen any type of deal that you can imagine at this point. I've worked with a ton of different companies. It was a lot of fun. I got to meet some super interesting founders. Most of them are still good friends of mine today. And I picked up a few tricks along the way, and I'll cover a lot of those here. But eventually I went to go and co-found Forecastr, which we'll talk about that here in a second. But I do want to mention that Steven and I used everything that we're going to talk about here today to secure a $750,000 pre-seed round. And we really had no product and basically no traction. And we did it in Louisville, Kentucky, which is a notoriously tough place to raise. And I bring that up not to boast, but just to say that this stuff really does work. And speaking to Steven, he'll be on here today as well, helping me out, answering questions, participating in discussion, chiming in from time to time. Steven's the CEO of Forecastr, and he has a lot of the same finance chops as me. He's a two-time founder, gone through Techstars twice, and he's just a great guy. He's got great experience. So if you don't know Steven, you should know him, and I will give you his contact info and his calendar link as well in the follow-up. So what is Forecastr? Well, in a nutshell, we help founders build amazing financial models online so that they can make better decisions, offer better reporting to investors, have more success and confidence while fundraising. And it's because we know how financial models get built today, right? Like an investor asks you for a financial model and you have to scramble to throw something together using some template that you found online, or you have to bang something out in Excel that you really hope doesn't get laughed at. It's a really tough process. And it's so tough that people used to pay me thousands of dollars to do it for them. And after a while, that started to seem kind of silly because as a founder, you really need to know your financial model and you need to know it inside and out. You shouldn't be passing it off to somebody else. And it's important to have a solid defendable numbers, and it's, really, really challenging to build them yourself. So this creates a problem. Founders need to build models so that they can understand them and use them, but they don't know how to use Excel. So that makes it really hard. So what we created was an online financial model. It's got a simple UI so that you can actually build and understand your projections yourself. And this makes the model way more meaningful and powerful. It gives founders a tool that will withstand really heavy scrutiny from investors, but I'll show you what I mean. So this is a demo of a financial model that I built online in our platform, and I just built it in 5 minutes. So in this one, we have two different revenue streams. We have the SaaS revenue and then a setup fee. And you can see things like number of subscribers, churn rate, all of that important stuff. You can use this little slider to look at different time periods and analyze different parts of the model. Then on the customer growth side, we can look at which different growth channels we're using. In this one, we're doing paid ads, partnerships, organic traffic. And you can look at each individual stage of the funnel, which we think is really important. And so the heart of what we're doing is trying to make forecasting easier and more meaningful for founders and investors, because we love forecasting, but we really don't like Excel, even though we use it professionally. And we're deemed to be experts by a lot of people because Excel is really clunky. It's hard to learn. And above all, it's unstandardized, meaning every model is different. So it's nearly impossible to compare them or automate. And we see a world where every model is still unique, but it's standardized on our platform. And that way you can compare yourself to cohorts, link up data sources, making it smarter and more efficient. We'll also have a team of experts that will help you along the way, from the initial build of the model to any, answering any questions that you have. So think Carta, but for financial modeling. And where we are as a company, we're pre-launch, but we're prepping a private beta. Hopefully, we're going to be opening that up here in the next month or two. So if you're not on the wait list, then I will send you a link to the wait list to sign up after the webinar. And we'd love for everybody on here to apply to be a user. We'll even build your model with you when the time comes. But that's enough about Forecastr. I want to set the stage for what we are trying to accomplish today. We want to talk about the ways that you can get the most out of your financial model in a fundraising capacity. But this assumes that you already have a financial model that you're using and that you're happy with. And what we're not talking about is how to build a financial model specifically. And the reason that we're not doing this is because it's a massively large topic. It requires a lot of these different webinars to accomplish. But we do have YouTube videos that we publish that cover this. So if you're interested, be more than happy to follow up and send those over your way. And if enough people are interested in that topic, then we'd be more than happy to put that on in the future. But if you do have a strong need there and don't have a great financial model, please let us know. Steven and I are here to help. This is what we do, and we want to make sure that everybody on this webinar has a great financial model. So now moving to what we are going to do today. What we are going to talk about is using your financial model for fundraising, assuming that you have one. We'll cover things like how to best organize your model, how to present your model, how to interact with it in the context in an investor meeting. But first, let's make sure that we're on the same page of what exactly a financial model is. Because if you ask 100 different people a question of what is a financial model, you're going to get 100 different answers. And it's because a model has a ton of different functions. Therefore, it has a ton of different definitions depending on who you talk to. It can encompass things like expense budget, a hiring plan, cash forecast, cap table simulator. There's a huge span of things that a financial model can do. But the best definition I've ever heard comes from Troy Hennicoff, who's a managing director. He's a former managing director of Techstars Chicago. But he uses an analogy that I think is perfect to describe financial models. It goes like this. So back in the early days of car manufacturing, the design phase looked a lot like these pictures that we see in the slide here. So engineers would build out full-scale replicas of their designs, and they would eventually create full-on prototypes of these replicas. And they would make some brave soul test these prototypes in real time. So testers would hop in these unproven machines, they would take them for a spin, and sometimes these cars worked, and sometimes they'd flip over into a barrel roll while taking a 90-degree turn. And the only way to know is just to build it and test it. So they basically had to create an entire car to see if their concept worked. And a lot of the time it didn't, and it was back to the drawing board. And then several iterations of millions of dollars later, you might have a car. And we think this is absolutely insane. They were wasting a ton of time building out these early models and risking lives in the process. So thank God for technology. Because nowadays, cars are built out soup to nuts using software. They can be designed and tested in minutes instead of months. And virtual cars now can drive on virtual tracks, take those sharp 90-degree turns. And if it flips into a barrel roll, nobody's hurt. You just tweak a couple components, and then you try again, and then you get it right. And the idea of building a full-on prototype before any software testing is completely laughable in 2020. And we think that this is the perfect analogy for a financial model. Because now, using technology, you can simulate your business and run tests in minutes, not years. You can see what happens whenever you add a new product line, or you try out a new marketing channel, or you invest in a sales force. And early on, you can even understand if you have a business that's even viable, or if you should switch up your business model entirely. And in a way, you're just seeing if your business can withstand that sharp 90-degree turn, or if it's going to flip into a barrel roll. But this way, if there are issues, then nobody gets hurt, not you or your investors or your co-founders, and it gives you a chance to optimize before jumping in head first and wasting a ton of time or money. So make no mistake, a good financial model can be the most powerful tool in your arsenal. So once you get this simulation built out and locked down, you have a plan with specific targets to hit. So the metrics and assumptions that you use to power your forecast end up becoming KPIs for your business afterwards. So I'll just look at a quick example here. This is one of the growth channels that we used early on in the video that I just showed. It's the email marketing channel. So what we're doing is we're trying to account for the behavior along each step of the conversion funnel from when we first reach out to a lead to when they eventually become a customer. So let's look at this example. In this one, we're emailing 1,000 leads per month, and we're targeting that 5% conversion rate from those emails down into a demo. Then we're targeting an 80% conversion rate from the first demo to the second demo, and then combinedly converting 70% of those last folks into paying customers. And we do it this way so that we can draw insights from each specific segment of the business and each segment of the funnel, and we can see where we need to optimize. So for example, would it make more sense to send 20% more emails per month? Or should we instead focus on increasing our conversion rate to a second demo to 85% versus 80%? Because you got to spend your time and your energy somewhere, and this process helps you figure out where you can be the most effective. And once you've set those assumptions and targets, we can see what your business looks like and plan for the long term. And you should also closely monitor this plan so that every month you're comparing your actual numbers to what you did in your forecast. So did you really send 1,000 emails last month? Did you really get a 5% conversion to demo? And if not, then you need to tweak and retool your assumptions. So you can see why an investor would be interested in taking a look at this. And your model's going to hold a lot of the answers to some key questions. And a lot of these, I'm sure you've been asked before from investors. I threw some of the more common ones up here on the slide. So how much money are you raising, and why are you raising that much? Founders usually have a really good answer for the first part of that question, but a lot of times they end up falling short on the second part. What are your sources and uses of capital? Hopefully sources will be the investor, but you may want to see what happens whenever you use debt as a portion of your raise instead of equity. Who specifically are you planning to hire, and what impact does that have on burn? Most of our costs are people, so everybody needs to be accounted for here. And how do you plan to grow your business? This goes back to the previous slide. What specific actions will your team do in order to ensure that the investor has the greatest chance of returning a profit? And if your model's buttoned up, then you can have bulletproof answers to all of these questions, which takes risk away from you and your investors. So I want to talk really quickly about why this is so important now, because Stephen and I believe financial modeling is always critically important, but we would also argue that it is more important today than it has been for the past 10 years. And why is that? Well, it's just simple psychology. So this is a screenshot of the S&P 500. It's the same index fund that I actually replicated and managed for 2 years at the Kentucky Pension Fund. And it's an aggregate look at the top 500 companies in the USA. And you can see how COVID-19 has affected its performance recently. And this is a common benchmark for the US economy. And you can bet that investors' personal stock portfolios are going to be tracking pretty close to this. And when you have a downturn like this, you have a psychological effect that comes into play because investors become much more risk averse. They're already getting plenty of risk in the stock market. So why would they invest in an even riskier startup? And it's our job as founders to reduce the risk for investors. And how do we do that? We give them transparency into our game plan with numbers. And we lay all the cards on the table and we show them our strategy. We show them exactly how we are going to spend their money and how we're going to grow using the assumptions that you and the investor reviewed together. And you give them confidence that you'll be good shepherds of their money, and that even in the worst scenarios, you have a plan that ensures that forecasted cash never hits zero. And if you convey this plan, and you convey this plan with a financial model, you can show them a forecasted income statement, a forecasted balance sheet, and a forecasted statement of cash flows. And you don't just do this because it's right, you do it because it is the language that investors speak. And if you do this, you'll not only earn their complete trust, but you also outshine all of the other companies that are pitching investors that don't do this. Okay, so we know that a financial model is important. So let's pretend that we have a good financial model that we're proud of and we're ready to hit the fundraising trail. We're going to assume that this model was built in Excel because Forecastr isn't quite ready yet. So we're going to have to ask ourselves, how can we organize this Excel model to clearly convey a story that inspires trust and investment? And there are 3 super easy, low-hanging fruit things that you can do that are incredibly effective and require really no Excel skill at all. And if you do these 3 things, I promise you will stand out. And this is coming from somebody who's seen hundreds and hundreds of financial models. And the first thing is a table of contents. It's really, really simple, but almost nobody does this, and it's so high impact. And it's basically an intro tab to your model. It should look as attractive as possible, and it should be highly organized. And as a rule, I try to make this page look as little like Excel as humanly possible. So here's a screenshot of an example. This is what a table of contents page might look like for Forecastr. And you can see how we have our logo large, and we have a link to our website right below the logo. And we try to ensure that there's no doubt whose financial model this is the second that you open it. And then the section directly below, you have every tab in the model accounted for in a linked list. Excel has the ability to hyperlink hyperlink to other tabs in the document. So you can just right-click the cell and you can add a hyperlink. It's super easy. And it's also super organized, very clean. And as soon as you open the model, you get a good idea of the structure. And it seems simple, like why is this so important? Well, it's because Excel is naturally unattractive. And trust me, investors get ugly, disorganized models all of the time. And first impression is so important. And if you open a model and this is the first thing that you see, you are immediately impressed. And also because Excel isn't standardized, whatever model you present the investor is going to be completely new to them, and they're going to have to orient themselves. And anything you can do to make their lives easier will be appreciated, and it'll definitely flatten the learning curve for them. And it also shows investors that you're highly organized and you can communicate well. And it's so easy to add, I cannot stress enough how important a table of contents can be. The second thing is a dashboard. And this is because humans just naturally respond better to graphs than numbers. We can interpret them instantly instead of having to use mental bandwidth to actually analyze numbers in our head. And an attractive dashboard with interesting graphs will really go a long way with an investor. It shows that you're actually interested in analyzing the output of the model, and you're not just showing them some model that you built in order to check the box for diligence. And you can include key metrics here like summary financials, unit economics, analysis of cost spend, just whatever makes the most sense for your business. And you can also quickly show investors what aspects of the business that they should be focused on and that you as a founder are most focused on. Like, are you displaying your cost per click over time? Are you showing the optimization of conversion rates for direct sales? You find the metrics that mean the most for your business, and then you analyze them on a dashboard. Because what that does, it just shows the investor that you know where you need to be focused and that you are watching it like a hawk. And of course, you also want to include graphs like revenue and cash, because investors are always going to want to see that up into the right direction. And they're always going to want to make sure that the cash never goes below zero. So like a table of contents, this should be as attractive as possible. You may even want to format this page in a way that it can be downloaded to a PDF, and that way you can just send it as a tear sheet showing the health of the business. This is what I used to do for a lot of my clients. It'll go a long way for investors because then they just have one page that they can look at and get a pretty decent high-level understanding of your business in just minutes. And then the last thing is just simple tab formatting. Again, investors look at models all day with disorganized, unformatted tabs. It makes models super difficult to navigate, and it's really, really hard to orient yourself whenever you're in a model. So remember, the investor has never seen this model before, and it'll be unlike any other model that they've ever seen. So you need to make it easy for them to just be able to pick up your model, understand it quickly. Otherwise, they're likely to get frustrated. And the frustration with your model sometimes can translate into frustration with you and the business, which of course nobody wants. So here's an example of tab organization that we use for one of our templates. So we color the organizational tabs green, the input tabs yellow, and then the output tabs black. The colors actually don't really matter so long as they're consistent. In fact, sometimes it's good to even stick with a color theme within your model. So if you can have tabs match your company colors in some ways, that's usually like a neat little thing that you can do to kind of separate yourself out. And if you notice, we have all of the tabs bundled together in the same category right next to each other. So the investor can focus only on the sections that they need to focus on at any point in time. And these are just basic fundamental things that are really easy to execute and that'll put your model in a higher category than the other folks that are pitching them. Okay, so you got your model, it's looking great. You put in a table of contents, you put in your dashboard, your tabs are organized and they're well thought out. And now you're ready to meet with an investor, show them what you got. So let's talk about some of the things that you should have up your sleeve and be ready to discuss. And these aren't things that necessarily you need to bring up in the meeting, but you should be prepared in case you have an investor that wants to take a deep dive into the nitty gritty. And this way you're prepared when they ask what they think are tricky questions, and you may be able to blow them away. So investors care about important metrics, and you need to be ready to defend them. If you can navigate conversations well around metrics and you have your metrics polished and ready to discuss, it will check a huge box for the right investors. And metrics can mean different things to different companies. So you have your universal metrics, which I tried to outline a lot of these on the left-hand side of this slide. We have things like burn rate, so how much cash is your company losing on a given month? Break-even date, when is your company going to become profitable? You have a variety of different margins: net margin, gross margin, EBITDA margin, cost to acquire customer, payback period, lifetime value. There's a lot of just universal metrics that investors are likely going to want to dig into. But then you also have your industry-specific metrics, and you need to do your homework to figure out what those might be. Because I try to outline some of them on the right-hand side of this document, but this slide isn't exhaustive. There's a ton of metrics out there, and you need to know which ones are the most important for your business. And once you've identified those, I even encourage you to have a metrics section of your financial model that shows your metrics and how they're likely to change over time. Trust me, to the right investors, it'll be a home run and you will earn a lot of their trust. But remember, whatever metrics you show, you really need to be prepared to talk about and defend. Because one of the worst things that can happen is that an investor asks about a common metric for your industry and you don't know what that metric is. So do your homework. Preparation is absolutely key here. And from experience, I know that every now and then you'll get an investor that asks about some weird metric that nobody's ever heard of. The best thing you can do is account for the important ones, be ready to talk about them and what they mean to your business. And we could do an entire webinar really on the different kinds of metrics and analyze their different meanings. And if the demand is there, please let us know. We're happy to put that webinar on. For now, just do your homework, learn about your metrics, but also if you need any help understanding your specific metrics, please, again, reach out to Steven and I. This is what we do, and we'd love to be helpful there. It's also really great to have a few different scenarios teed up and ready to talk about for investors. So investors are always going to want to understand the various possible outcomes of their investment. And the more that you can get out ahead of that and show what a base, best, and worst case scenario might look like, the better off that you're going to be. And I'll give you a real world example here. So whenever Steven and I were raising our pre-seed round for Forecastr, the goal was always for that round to get us to post revenue. But what we showed investors was that their $750,000 investment would carry us 18 months, even with no revenue at all, which would buy us plenty of time to build product and raise a second round, even in the worst case scenario. And that made them super comfortable because even if we made zero, then we were good for 18 months. And that seemed like a pretty good amount of time to come up with a plan and make sure that the company didn't die. And of course, in conjunction with that, we also showed them what we thought a realistic revenue forecast could look like if we hit our stride and we were able to make those sales. So a model should represent what you think is realistic, but you should also be able to play devil's advocate and allow you to illustrate a plan if things don't go as well as you might think. Because remember, investors are trying to minimize their risk. So if you can show them that you have a plan for the worst case scenario and that the best case scenario provides plenty of upside, then you'll show them that they have a pretty good risk reward ratio, which is really what they're trying to optimize. Okay, so we have this great model, and now how should we showcase it in the context of an investor presentation? So let's dive into that. So the key to showing a projection slide in a investor presentation is to keep it high level and not go too deep into the weeds. So this is a sample of our financial projections that we used in our deck during our pre-seed round. And if you'll notice, we really didn't put a ton of numbers on the page or go through all of our assumptions. We included a graph that shows that up and to the right trajectory and a few large numbers with margins, run rate, customers, etc. because the goal of this slide was not to convince investors that we had the world's greatest financial model. What we were really trying to show is that the business can be big and that our assumptions that we were using to drive the forecast weren't crazy. So do what you can to convey that message and then move on. And graphs and big numbers are a great way to do this. And the biggest reason for this is just number fatigue and analysis paralysis. Because remember what a pitch meeting is meant to be. It's meant to be you telling people about your business and your team and your traction. And it's not meant to be a deep dive into the economics of your company. And if you focus too much on it, then you'll burn up a lot of time in what's meant to be a short pitch. And it's really tempting to show off all of that hard work that you put into your model, because you can back up all of that logic growth beautifully if you've done it right. And you can communicate your game plan really, really well. And trust me, I went through that. I had a great model that could withstand even the highest scrutiny from investors whenever I was raising. And Stephen and I both wanted to show it off. But there's always a time and a place for that. The goal of a pitch is to get that next meeting where you do that deep dive into the numbers and show all of that beautiful logic. Trust me, if they like your pitch, that meeting will come soon after. But if you do want to include materials in your model, it's always great to throw them in a detailed appendix slide. So we like to show slides like unit economics, metrics, detailed 5-year projections. That way, if an investor has a question involving one of these, you can just flip to an appendix slide at the end of your presentation, address it in real time. It shows that you're prepared, that you've done your homework, but the key is just not to harp on it too much in the pitch itself. Okay, so you've done your pitch, you've gotten the follow-up meeting to dig into the numbers. What do you do now? Well, there's a process here that will set you up for success. And there's really 3 time periods to look at in an investor meeting. It's before the meeting, during the meeting, and after the meeting. So we're going to go through each of these and break them down individually. So before the meeting, do not send them your financial model. And there are a lot of different opinions here, but I actually feel really strongly about this, because you don't want a model to live on its own. You need to control the narrative and present the model to them in person or on a call. And this will do several things. It will give you leverage to get the next meeting. And if they're interested in your business and want to dig in, then they're going to need to do it with you in the room. But it'll also demonstrate your understanding of the model when you present it. And remember, showing an understanding of your model is showing an understanding of your business, because the model is a simulation of your business. So those two things directly translate. But most importantly, this allows you to control the narrative, because when an investor first sees your model, they will form an opinion on it. And you need to be there while that's happening so that you can control how that opinion is being formed. Because it's really easy for an investor to get the wrong impression of a model whenever they don't have context. And if you like it or not, once that initial first impression is made, it is super hard to change it, even if the thing that's initially giving them pause is super explainable. So you need to be there to present your model. And while you're doing that, during the meeting, you need to be in control, because people go into these meetings ready for battle, thinking that they need to defend their model against that big bad investor that wants to just tear it to shreds. But you don't let that happen, because this is a working session where you and the investor are working together using these models as a tool to analyze what you think is realistic for your business. So you present what you think is realistic, and then you have a discussion about that. And if they have different opinions, model them out in real time and analyze a bunch of different scenarios. And also ask about their opinions and show that you value their input and their experience. Because remember, this is a working session. So you guys are working together on this and coming up with a consensus of what you think is the real scenario for your business. Respond to their ideas, offer some of your own, present and brainstorm, all of that stuff. And if you know your model well, this should not be a scary meeting at all. It's perfectly okay to say, I don't know, let me dig into that and get back to you anytime that you have a really difficult question. And then after the meeting, follow up. Summarize what you talked about in an email and include a copy of the model only after the meeting. And if they asked about a specific scenario that you didn't get to in the meeting, run that scenario, summarize the outcome, send them a version of the model with that scenario. And if they ask you a difficult question during the meeting that you didn't know the answer to, follow up with an answer after talking to mentors. And by the way, Stephen and I are always open to helping founders answer tough finance questions from VCs. So open invite there. Just never hesitate to reach out to one of the two of us. If they said something that prompted you to do further analysis in the model, tell them about it, show them. It's a great way to earn back brownie points with investors. The key here is just showing them that the meeting was productive and that it meant a lot to you. Okay, so hope you guys found some of this stuff helpful. And I know that a lot of the material, there's a lot of material, we covered a lot, but I will send you guys a copy of this video and all the slides and follow up. But the presentation was about 36 minutes, so we have plenty of time here for Stephen and I to answer any questions that you have, or if you just want to have a free-form discussion, that would be great. So I will open that up now. And Stephen, I know that we had a few questions come in.
Yeah, we did. And I answered some of them in chat, but one was related to, do we have a template that we offer that that folks can use? And the answer is yes, we can send that out after the meeting today. It has everything that Logan just described in there, table of contents, dashboard, and it has, bottoms up revenue forecasting, kind of everything that you might be looking for in a model. And yes, we can send that link out. Sam wants to know, is Forecastr a product that we should use in real time while in a VC meeting?
Yes. So in a meeting, usually the way that these things work is like you present the model that you've prepared with your team, and you can go through it traditionally it's been in an Excel document. Obviously, Stephen and I are working hard every day to change that. But that's where the kind of working session comes into play. Whenever Stephen and I were raising our round, we would always like to run different scenarios to see, what would happen if our conversion rates were better than we expected, or what would happen if we went and hired an additional developer to expedite our time to market, or what would happen if we raised a slightly larger round or less of a round. Again, like the name of the game for investors is they're really trying to reduce their risk while also maximizing their upside. So I'm a huge fan of running scenarios real time in a way to do this. Like I said, Stephen and I ran for pretty much everybody I think that invested in our company. We ran them that scenario of zero revenue. If we didn't make a dime in revenue, what that would do. And it really went a long way. So definitely I'm a huge advocate of using it real time in a meeting. Yeah, Jason, I see you're gonna create a table of contents and dashboard today. That's a great call. It's such an easy way to clear up a model really, really quickly, and it takes no time. Okay.
And Sam, to answer your last question, Logan, he asked about is Forecastr a product that we do not have to create, some functions and things like that? Yeah, that is correct. The idea of Forecastr is that it's a financial model you can create without having to have a lot of technical knowledge regarding, some of the mathematics of how these models work. So that is true.
And I will expand on that as well. So yes, you will not have to know any Excel formulas. And Stephen and I are also going to be offering this product with kind of a managed services layer. So on the front end, we will help you build out your financial model just to make sure that it's really investor grade. Oh, Jason, okay, see yours. How far to forecast ahead? The standard is 60 months for whatever reason. Usually 60, well, I guess there kind of is a reason for that. Because we're startups, 5-year forecast theoretically should show past break even. So most companies that are startups obviously are losing money for the foreseeable future, but eventually an investor is going to want to see that uptick where all of a sudden you're not just a company that's losing money, you're a company that's making money. And usually 5 years is an adequate amount of time to do that. So 2 years at least for us would likely not be a time frame where we would be showing profitability. So 5 years is really the gold standard there. Any other questions? Or Steven, is there anything that you wanted to cover that maybe we didn't touch on as much as?
Just kind of scrolling through to see if I missed any questions here.
Well, one thing that I'll say while you're looking, so I touched a little bit while I was giving the webinar about future webinar topics. So some of the ones that we're talking about now are how to build a revenue forecast or how to build a financial model. That's one that's kind of like up on our list. But we'd be really curious and you know, different topics that you all would find interesting, and we can chat about that in the follow-up.
Jeb would like to know how the model evolves as the company stage evolves.
Absolutely. Yeah, so great question, Jeb. So a financial model is a constantly evolving document. Like, so for example, if you're a really early stage company like Forecastr is, we're pre-launch, most of our growth assumptions at this point is theoretical. You know, we can put in what we think are going to be realistic conversion rates for our different growth channels. And it's really almost more of a thought experiment in terms of how we think that we're going to grow the business. Over time, you get better and better data that allows you to get more granular and more sophisticated forecasts. So for example, you know, for us, we might talk about how we are going to be reaching out directly to startups and converting 5% of those into paying customers. But if you're a Series A to Series B company, you've probably got really, really granular data on historical growth rate of website traffic and different conversion rates of different marketing channels. And you can break it out in really detailed and organized fashion. So I would say the biggest way that your model evolves over time is as you aggregate more and more data, and you want to include as much of that data as possible in order to get as much of an accurate forecast as possible. That data is also very interesting to investors, by the way.
Yeah, and I'll add to that just saying that one of the ways that Logan and I talk about financial modeling, this is more towards building the model, but I think is helpful, is in the same context as product development. Everybody talks about product development as something where, you know, you release an MVP, something that's basic, something that's simple, something that's stripped down. And then as you grow the business and as you kind of validate the business, you kind of beef it up. You make it more complex, you make it more holistic. Same thing with the financial model. When you're just starting with the business, make it simple, basic, streamlined. It still should be bottoms up and metrics driven in the way that Logan was talking about, where you still do want to be predicting, you know, how your business will actually work, but you can keep it at a fairly streamlined state. And then as you grow the business and as you get into the market and as you get better data, you're building on top of that model and increasing its accuracy over time.
That's great. And Sam, metrics webinar sounds like a great idea. Yeah, I like the idea of that webinar topic as well. So that may very well be our next one. But we like the idea of doing these webinars, especially while we're pre-launch. And in terms of our subscription charges, I would say that we're still very much trying to figure that out. We are pre-product, obviously, right now, so we're not entirely sure what that will look like. So yeah, still kind of probably going to be testing that over the next month or two. Okay, well, I would say if there's no other questions, we could probably cut it off a little bit early. Oh, who's the team consist of? So the team is actually right now, Steven, myself, and then we have two technical co-founders, Stephen Ames and Jonathan Frazier. And Stephen Ames is really our front end, like UI, UX guru. And then Jonathan is our data guy. He's got a degree from MIT in data analytics, and he's been the CTO of a couple of other companies. So we've got a really good team behind us, but 4 of us right now. Great. All right. Well, thanks everybody so much for coming out and joining us. And like I said, we will be following up with the materials that we went over today, along with the recording of the video. So we'll keep you guys up to date with additional webinars in the future. We had a pretty good turnout for this one, and I think that we're going to continue doing these. So thanks so much for being at our first one.